Are you a builder struggling to find financing for your project? Maybe you just don't want to deal with the banks and you're looking for an alternative way to get these projects funded? My name is Mike Chadwick and I've been in hard money for over a decade, and hard money is a perfect vehicle for ground up construction projects. And in this video, I'm going to explain exactly why.
So a hard money loan is really just a bridge loan. It's really just a bridge loan from a private lender, an unregulated lender. So what are the benefits of hard money loan? Why do investors, first-time flippers all the way to investors with thousands of units? So I've closed over $1 billion in hard money loans, and I can assure you one thing, not every project qualifies for hard money.
So what are new construction loans, and how do they differ from maybe more of a traditional loan, like what you would find if you were going to finance the purchase of your house? And it's simple, right? So a purchase loan, like the one that you would get for your house, is going to look at your financial wherewithal, is going to say you qualify for X down payment, and the lender is going to fund 85% of the purchase, right? It's that simple. The loan is fully funded at close, and then the borrower goes ahead and makes their loan payments. Maybe it's interest only, maybe it's principal and interest, and maybe it's 30 years, but it's a fully funded loan at closing. A new construction loan is a loan with a construction escrow for the completion of a house. And as a construction lender for the last decade, most lenders want to control the money that's going to be needed to fund the construction. So here at ABL, and again, like most lenders, we're going to want to control those funds. So we're funding 100% of construction. And yeah, that's right. We're going to fund 100% of construction. So at the end of the day, we're going to fund a percentage of a lot purchase. Typically, we'll fund 60 to 70% of the lot purchase. That requires the borrower to bring 30 to 40% down. But we're also going to fund the construction piece and 100% of it. And we're going to look at the loan and your ability to complete the project, right? So we're going to, a bank is going to say, okay, you have the financial wherewithal to qualify for a loan of this or a down payment of that. Your credit score is this, and you have this much money in the bank, and you have this debt to income ratio, right? We're not going to care about debt to income ratio. We're going to care about liquidity for the borrower to have a little working capital. We're going to have a minimum credit score requirement, but as a common sense lender, right, we're going to look at your experience and your ability to execute the building of a spec house or whatever your ground up project is, right? We want to know the borrower can actually execute, because we're lending all of the money and we're going to lend against the future value of the house upon completion. So we need a borrower in place that can take the project from start to completion first and foremost. So we're going to look at your experience as a hard money lender, and in the context of that, within the new construction loan program, we're going to lend to borrowers who have at least one project under their belt on spec, which means that you've built a house on spec, but you're on title. So there's evidence of you building that house that an underwriter can refer back to and say, yup, the borrower's experienced, check. They've got that one house built. We're going to come in and fund. We'll fund borrowers with no experience as long as they partner with a general contractor that does have experience. And then we're going to reward experience with borrowers that have more builds under their belt. You're going to get a better rate. We might lend more as a percentage of the total project costs, which we'll get into. But generally, at the end of the day, the more experience, the better. The more experience you have, the higher probability your loan's going to be approved. But these new construction loans are, especially from a hard money lender, are going to be all about your ability to execute the strategy. They're going to not just have a funding at closing, but have a construction escrow that's going to fund the completion of the house. And ultimately, that gives the lender comfort that the money is going to be there, that they're lending against ultimately what will be a new house, as an example, as their collateral. They say they want to be, or we want to be 65 to 70% of that after repair value in the end. And ultimately, as a lender, we're funding towards the completion of that project. You're going to start off with a loan balance with a new construction loan that's going to be low against the land. And then as you take draws, it means you're completing work, and we're going to fund you through reimbursing you for work that you've completed all the way up until the loan is fully funded. And then at that point, the loan is repaid through sale or refinance. So hard money loan programs in particular are great for new construction loans because we're charging interest typically on balance. And while interest rates are higher than going to a bank, your balance is low going in. You're not getting charged interest on the construction escrow until you take that money, and you pay more interest over time as your loan grows. And it gives an advantage for hard money lenders to play in a space like this because we're fast and we move borrowers not just through closing quickly, but also through the draw process. That is just as important in getting your project completed and ultimately sold and on to your next one. So when it comes to construction costs, what do you mean by you'll fund construction costs? What does that entail? And it's simple, right? We're gonna fund construction, reimbursing you for the work that you've completed. And we're going to do it for both soft costs related to the project and hard costs, right? So let's say you have architectural costs associated with the project, you have engineering costs, you have permitting costs. We'll fund those here at ABL in our new construction loan program because we know that they're part of every project, right? And obviously we want you to go about it the right way and pull permits. So we're gonna fund those. And those are the only items that we would require an invoice or a paid receipt to prove evidence that those items were completed, were funded by you, so that they qualify for reimbursement. The rest of the work, and we're talking both labor and materials, all the way through construction, starting with site prep, site clear, foundation, utility infrastructure, leading from the road to the foundation, all of that work, we fund all the way through completion. And we can fund it whether it's stick built, maybe it's a modular coming in where you're preparing the site and the foundation and then a house is being delivered to the foundation and being built off site. We've done all different types of projects. Like, it's fun to structure those, but we fund 100% of construction and we mean it. That means soft costs and hard costs. The process is simple. It's a standard draw process that on a 1 to 4 unit, single family to a 2 to 4 unit multi, we're gonna do virtual draw inspections and we're gonna fund upon evidence of work complete. And it's a very simple process that takes 48 to 72 hours to go through. And like everything else, speed is the name of the game in this business. So we're funding 100% of construction. We're funding both soft and hard costs. We're doing it quickly and we're keeping your project liquid all the way through because our project is fast and efficient and we use technology to make sure that happens. So you're going to enjoy a hard money loan process versus going to a bank all day long. There's no doubt about it in my mind. Who are new construction loans for, especially from a hard money lender? And the answer is really simple. It's really anyone that's building for investment purposes. It's just that you have to be experienced in one way or another. We don't lend to owner occupants. We can't lend to someone who is going out and hiring a builder on contract to build a house they intend to live in. Our loans are meant for investors, and you don't have to be a licensed general contractor. You can be an investor who has worked with several general contractors in building homes on spec. It's just that you need to show evidence that you've either done so, title, meaning that you have evidence of homes that you've completed that you've been an investor on, whether you've built them personally again or not, or if you're a general contractor who hasn't been an investor in a spec build per se, but has built houses for others, we're just going to ask you to provide evidence of those permits in order to show that you've in fact built houses, right? Because everything in a hard money loan program comes back toward is experience, right? I mean, we have minimum credit thresholds, in this case for a new construction loan, it's going to be a minimum credit of 660, and we have minimum liquidity requirements, which is to make sure that you have the working capital to go through closing on a loan and putting the amount down you need, pay closing costs, but also to be able to buy materials and keep the project funded so that you have the ability to bridge the gap between doing the work and being reimbursed through our construction escrow for that work, right? So those are the two financial components, but it goes back to experience always for a lender like us. And we want to make sure that you have the ability to execute the strategy because we're lending against that future value, right? As a construction lender, we're lending 100% of the construction funds. We're putting that money in escrow. It's not earning any interest. We want to deploy that money as fast as we can. We want you to move quickly. And at the end of the day, we want you to have the experience to execute. And if you have that experience, we can have the flexibility on the credit side at times to accommodate a borrower who is actively building several houses who sees their credit fluctuate. And that's one of the big pro tips I would say for builders coming to a hard money loan program is that we're lending to an LLC, which keeps you off the books, off the radar of creditors. We don't report to credit agencies as a private lender, a hard money lender. So builders who suffer fluctuations in their credit based on how they borrow from other lenders and traditional banks, and in those cases dealing with these debt to income ratios that they're constantly managing, we tend to be able to allow borrowers the ability to isolate their personal finances with their business and to be able to keep their banks that they deal with on a personal basis from seeing their investments, their spec bills, because they're doing a loan with us. And that's an important thing because that reduces the volatility of a borrower's credit just simply by using hard money to fund their new construction loans. So as a hard money lender, how do I structure a construction loan? What's included in the calculations, etc.? And it's pretty straightforward. As with all of our hard money loan programs, here at asset-based lending, it's experience driven, right? So the more experience you have, the more you qualify for in terms of leverage, and you'll obviously get better interest rates, etc. But we're going to focus on loan structuring in this case. And let's say you're a borrower that's done 10 new builds on title in the last 3 years. You're growing your business and you're looking for a new lender that can help you scale. And you're trying to figure out how I'm going to structure your loan, right? And let's say you're coming in, you're buying a lot for 100 grand and you are constructing the house for say 300,000 and you think it's going to be worth over 600 when you're done. Mike, how do you structure it? And it's as simple as this. Borrower at that experience level qualifies for as low as 30% down. I'm going to fund 70% of the land plus 100% of construction. So my loan is going to be $70,000 funded at close, and we're going to hold back in escrow the $300,000 for construction, and we're going to fund that in draws. So my loan is going to be the 70 plus the 300, the 370. You're going to get charged interest on the 70 at closing, and as you fund the work and get reimbursed for that work completed through the draw process, like we'll talk more about, your loan is going to grow. You're going to pay interest on the growing loan balance through the draw process, and ultimately your house is built, sold, and we're repaid. But structuring of the loan, it's going to be 3 different components. We're funding against a percentage of purchase like any traditional lender would, and we're being mindful of the as-is value of the lot and what you're purchasing it for and how much skin in the game you have, which bridges us over to loan to cost. Loan to cost is purchase price plus the amount of construction. We're going to want to make sure that we're never lending above, say, 90% loan to cost, and similar to after repair value, which we'll move to next, is one of those metrics that you're going to have to comply with as a result of your down payment. So like what I like to tell people is we're structuring loans with 3 different metrics. Loan to purchase price, which is effectively what's my down payment. Loan to value, loan to ARV, which is what's the future of the house when fully funded in the loan, our loan to value, loan divided by after repair value. And then what's our overall loan to cost? And that's simply our fully funded $370,000 loan divided by the total costs of, in this case, the $100,000 purchase, the $300,000 construction, so in total $400,000. And what are we funding? Are we over? In this case, we could be over by a couple points. And so therefore, what do? We ratchet down the going in loan amount a few bucks, and maybe the going in funded amount for us needs to be 65%, not 70, based on the end value or based on the total project cost. So we're going to look at borrower's experience to dictate how much leverage, which is across 3 metrics, LTV, LTC, and LTP. And we're going to look towards ultimately making sure the borrower has enough skin in the game relative to the scope and size of the project. Construction lending, in my mind, should always focus in the end loan to cost. And it's a focus of ours here at ABL, and I think it's a focus industry-wide, where it aligns borrowers with the scope and size of the project. If you're coming in and you're looking to build $1 million project, well, you're going to need more than 5% down because there's really not much on the line for you to lose. You might have to have $100,000 in the deal. Even if maybe your lot costs $200,000, you might have to have 50% down. It's because the lender wants you to align and make sure that you have enough skin in the game in order to protect the project on a downside if there are overruns. So experience is going to dictate. We're going to talk about how that matters throughout my channel, especially when it comes to fix and flip loans and new construction loans. But in ground up construction, experience is paramount. It's absolutely driving the bus when it comes to rate, but particularly loan structure. And it's a balance of metrics and it's skin in the game that drives the decision making when it relates to us making a loan as a hard money lender to you as a borrower. Hard money loans are perfect funding vehicles for ground up construction. We do a ton of new builds here at Asset-Based Lending because the process with a hard money lender is fast, it's efficient, and there's nothing more important with a new construction project or a ground up project than keeping the project funded and liquid. That means getting to a closing for sure, and we can do that in 2 weeks or less, but it's about the draw process and keeping those draws moving fast and keeping that project funded. Our draw process takes about 48 hours. We do so through a virtual draw process on 1 to 4 unit properties where you're virtually uploading, meaning you're taking pictures of the property on site yourself. It's geotagged, and we're funding projects through construction completion on virtual construction draws. And that's the future of construction lending. And that's what we're doing here at ABL. So let's talk requirements. What do you need in order to qualify? I really put it into 2 categories. You have experience and you have credit worthiness. We're going to talk experience. We're always going to be talking experience, but to keep it simple, we're going to need an experience worksheet that outlines your experience on title, which means that you had a percentage ownership. You can provide an operating agreement that shows that you were in fact linked to an LLC that owned a property. It doesn't need to be something that's proven right out of the gate. And a lot of what we do here, especially when it comes to bridge lending, I like to say, is that we trust all the information and then we verify. So trust and then verify is an important saying for me here, in that we're going to take your word for it in your experience. We're going to take your experience worksheet. We're going to look at it. We're going to approve the loan, issue terms based on that experience worksheet. We're also going to do the same on your credit score. So when it comes to credit worthiness, we're going to want to make sure that you have at least a minimum credit score, 660. You're going to tell us verbally that it is higher than 660. It could be 750, it could be 661, but you're just going to say, yep, it's that, and that you have a certain amount of liquidity in the bank. And that amount fluctuates depending on the deal size, but we want to make sure that you have a down payment, you can cover closing costs, and then we want to make sure that you have working capital on hand to be able to make loan payments and to fund material costs, to be able to get the work done and then be reimbursed through our draw process. So we have experience in one bucket, we have credit score and liquidity as our credit worthiness bucket. And those are the 2 categories that we'll look at in terms of you personally satisfying requirements. We talk about experience drives leverage and pricing, and we talk about really the credit, score being a minimum, the minimum liquidity is another minimum. That's really what I would say the bulk of the personal requirements, the borrower requirements. We don't have tax return requirements. I'm not going to ask you for your W-2s. I don't want to contact your employer. I'm not looking for pay stubs. I'm looking for basically, and not at the approval stage, but in the future, we're going to ask for a bank statement that proves that you have that money in your account, and it's a minimum. It's going to be that you authorize us to pull your credit. And then once the loan's approved, you accept our terms, we're moving forward, then we're going to ask for an authorization form for us to pull your credit and background. And background will be another component, right? It's we want to make sure that there's no criminal activity on your background. But other than that, it's a standard background check. Both of these, let's call it background check and credit report, will be pulled once every 6 months, like we talked about. But in the end, those are the 2 main categories. You have the experience bucket, you have the creditworthiness bucket, minimums on one side, experience verification on the other, that drives pricing and leverage. And we're doing all of this with a trust where we're verbally getting this information, and then through the process, we verify and we collect the documentation that onboards you as a borrower, and then obviously qualifies you through credit pulls and experience verification as we go through, wait for the appraisal and title, etc. We're doing all of that as we move to a close. So the requirements on a borrower personally are limited and very doc-light, borrower friendly, and that's the name of the game in this business. What's the process like to go through and obtain a new construction loan with a hard money lender? And it's simple. It's doc-light, it's borrower friendly. Trust me, send me your deals, but we'll talk through it right now. It's as efficient as a 24 to 48 hour approval process with 4 things. I need an experience worksheet, I need a construction budget, I need plans, and I need a filled out application. We go through the quick underwriting, the loan gets approved, term sheets issued, we're engaging the appraiser, and we're dual tracking the receipt of the appraisal with title, with insurance, and then when everything comes in, the appraisal comes in, we'll have already run credit and done and collect the documents on the entities. We're moving to a closing about 48 hours. So loans are approved in about, I would say, 24 to 48 hours, and we're closing right now on average in 10 days. Post-closing, construction draws are done virtually on 1 to 4 unit properties, single family new builds. I mean, you're going in as a builder and you're taking a picture, you're uploading pictures, and we're funding on work complete. And so the process to close is fast. The process post-closing to completion is fast. And that's the name of the game in this business. It's all about speed of money. And it's not just to get to a close. It's about getting the borrower's money and funding the project through to completion. The one thing that's unique about me, and I think separates me from maybe some of the other loan officers in the industry, is that I've actually been on the other side of the table. I did 100+ fix and flips with credit union, bank, both regional and national financing. I've also built 16 houses with bank financing. I know what it's like as a borrower to be looking at the bank requirements to say they're never ending. It's a financial proctology exam with tax returns and all this paperwork. And then you close finally, and then you're just bogged down by lien waivers and invoice support for draws and things that hard money lenders like myself don't require. After having gone through that on the borrower side, it really is refreshing to be able to offer that on the lending side, to be able to offer an experience that mitigates certain pain points that borrowers and builders have in obtaining financing. It's natural for, in my mind, hard money lenders, for private credit to step in and fund construction. It's a high touch business, and you need the flexibility in your capital to be able to satisfy borrowers and to help them grow. Being on both sides of the table, I believe gives me a unique perspective that I hope to build, this channel on. And, I want to thank Asset-Based Lending for continuing to sponsor these videos. And I know that I've covered a lot when it comes to new construction. There's a lot more in the details that we are certainly going to discuss on this channel in future videos with, a particular emphasis on the draw process in particular. But we're going to talk a lot about new construction. We're going to talk a lot about construction in general. Please, never hesitate to ask questions. Ask, in the comments, subscribe if you enjoy the content. I'm going to continue to make more videos on hard money lending and just how our loan programs can facilitate transactions and help you grow as an investor or a builder. Thanks for watching.